So in this lesson, we're going to focus on a trade and some upcoming potential trade strategies in light of what the focus on this lesson is, and that's on multiple unit trade strategies. So let's take a look at the SPY data. The data that's shown on the chart right now, this is the weekly SPY data. In the DT reports, we use the SPY for the go long or short recommendations for the stock indexes, but many subscribers, and of course myself included, we might do our analysis and a trade alert on a unleveraged market like the S&P cash, or the SPY, or even the ES, or one of the other indexes for that matter. But we might take the trade in the futures markets and frequently in the ETF markets, and meaning ETF with leveraged bull or bear markets. So the stock indexes all have what they call leveraged bull and bear ETFs, where they're 2 times and 3 times leverage instead of just 1-to-1 leverage like the SPY is or the SPX index is. So given that light is use this information one way or another. Whenever you have a high probability setup, if it's too much capital exposure for a leverage trade, then there's lots of other choices, as I've mentioned all through the courses up to date. Okay, once again, this is the SPY weekly data. We'll just kind of briefly look at the position of the market as of the last bar in the chart. So as of the last bar in the chart, it's an outside week to close bear reversal. And that, of course, means it's an outside week where the weekly close was below the closes of the past 2 weeks. Now, that alone should be a wake-up call for a potential weekly high. That's a pretty serious reversal. Some strong selling came into the market that week. And it's not just an outside week, it also made a new all-time high as of that week. So that high, as you'll see, was also made right about within 1 or 2 points, it looks like, of the 127% external retracement of this last decline. That was a piece of information that also indicated that it's at or near potentially a weekly high, and in fact even a potentially higher time frame high. We're going to keep it real simple here, just identify potential market position and then look at the specific trade strategy. So 127% external retracement. This week, the week ending January 6th, was also this just one simple time factor of the high to high to high. So that would, we might want to be alert to a weekly high around that time also. And then look down at the indicator windows. I've got 2 momentum indicators on here. It's the DT oscillator. One is an 8 look back, and the other is the 13 look back. Now, my cursor is at the 8 look back, and it didn't make a bear reversal as of this really wide range outside to close bear reversal week. Came pretty close to it, just within a fraction of a point or 2. But what is the position of the momentum relative to the position of price? It's pretty simple. We've seen that many times in past lessons, and it's a price momentum bearish divergence. And that's because the price high is at a higher high than the last cycle high, both in price and in momentum. But the momentum currently is at a much lower level than at the last momentum cycle high. So it shows that the market's running out of buying power, that's running out of speed. Remember, momentum indicators pretty much represent the rate of change or the speed of the trend, and that it's just running out of momentum on the upside, speed on the upside. So the momentum's at a much lower level than it was at their last high. So that's a wake-up call for a potential weekly high. And if we go down and look at the 13 look back, we can see that the 13 look back has actually been net bearish since the last price cycle high, even though the S&P has been essentially sideways to even up a bit over these past several weeks, and not up by much at all, at least from the weekly close to the weekly close. The weekly close of the last bar in the chart is below the weekly close of the last cycle high. So it's has been warning us for some time that we want to prepare for a probable weekly top. With the price bear reversal week outside, too close bear reversal, that's a wake-up call to go down the smaller time frame and see if we've got a trade set up on the short side for a futures trade or possibly for a bear ETF. Let's go down the daily data and see where we're at. So here we go with the daily data as of that last weekly bar in the chart. This is January 7th on Friday, and that was the last weekly bar that made, these are the Tuesday through Friday bars that made the outside reversal week. Let's just take a look at a couple pieces of information on the daily data. Is we had some other time factors here. They're spread out over 3 or 4 trading days, but they're all significant ones. And this is a high to high to high, similar to that weekly high. The difference is this high that I used was not the highest high that was traded in this little time period, but it was certainly the highest close. So that's kind of what I look at. If there's a congestion period, I focus on what is the highest close. So high to high to high was a few days ago, prior to the top anyway. The 100% alternate time projection of this last advance from the low was, looks like just a day before the high so far, and that's significant. And then a couple days after this high, well, no, just one day after this high that was made on January 4th was the low to high. So as you know, this time factor is very significant. A low to high usually identifies what will be the maximum time before a high is made. So the high today was made on January 4th, just one trading day prior to the January 5th trading day. So we had a lot of information here that are right around this late December, early January time would be at least a weekly high and potentially even a higher time frame high. So as of the last bar in the chart, the daily momentums are just reached oversold. So it's certainly not in an immediate position for a trade setup. So what's the trade strategy we might use? Well, it's that GAN strategy. I use it all the time, is that once we've made that reversal, as we look for the initial correction against that reversal. And because the daily momentum's already oversold, is that more than likely it's pretty close for making a daily low and then making a corrective rally of 3 to 4 days or so. That would be the typical corrective rally. So that's what we're looking for. So I'm going to add some data onto the daily chart. First, we want to confirm when a low is made, and then let's look for a correction against that initial low. So here we go, daily chart. I'm going to add some data on. There's 1 day, 2 days. So we had a sharp decline that the next day, this would be on a Monday, but then closed near the high of the day. And that's significant. It's not a specific price reversal day, but it's a wake-up call that the market's in a position potentially for making at least a daily low on this initial decline. Then we had a strong up day the next day, made daily momentums, made dual look-back bull reversals. More than likely, the market's going to be sideways to up for 2 or 3 days anyway, making a corrective advance. And when that correction is complete, followed by a continuation of the bear trend. So let's take a look here. The first thing we want to do is just put some simple retracements on. And boy, already as of just 1 day after the low, the SPY has advanced strongly above the 50% retracement. But the daily momentum is just made a bull reversal. So should have at least another 2 to 3 days sideways to up. So ideally, we get the daily momentums overbought, and they make a bear reversal, and that would be the ideal dual time frame daily weekly momentum setup to complete a correction, followed by a continuation of the weekly bear trend. Now, that doesn't always happen. I always really want to focus on the pattern and also the price position that may sort of override the immediate momentum position, because momentums don't always get to overbought and they don't always make bear reversals when the price reversal is made. So what I'm going to do, I'm going to add another bar or two of the daily data on, and then we'll take a look at it and reassess the situation. The key here is that this market is in a position to have completed a weekly high. Notice my language, in a position to have completed a weekly high. So we're looking at the immediate position of the market for the potential end of what we would consider a probable wave 2 or B correction. Now, it's already reached the price retracement, typical for a wave 2 or B, and that's the 50% retracement. And of course, around the 78.6% retracement is typically the maximum. Let's add another day or two of data on here. So I've added just a couple more days of data onto this daily chart. Let's take a look at where we're at. So as of the last bar in the chart, the daily momentums aren't overbought, and usually we want to see them overbought to give us a warning that the market's at or near a daily high, which in this case would probably be a corrective high. However, where is the market at? Where's the SPY at as of the last bar in the chart? Well, it's already reached above the 62% retracement, and the high of this last bar is not too far from the 78.6% retracement. Now, that's typically near the maximum of where a market would make a retracement if it's making a corrective rally. So what we can say is of the last bar of the chart, the market's in a position, price position at least, to have completed a wave 2. So what we might want to do here is go down to intraday data. Now, I'm not encouraging you to follow intraday data during the day, although it can be helpful if you have the schedule that allows that. But it can be helpful at the end of the day as well, is to help to clarify the potential position of a market. So we'll take a look at the 60-minute data for the SPX as of that last bar, daily bar in the chart. And here it is. This is as of January 12th. So coming off of the January 4th high, what a beautiful 5-wave decline, isn't it, into this low. And I have that labeled as a probable wave 1 or A low. So I'm not making the judgment if the SPY is making a corrective decline or a impulsive bearish decline, just that it should make at least 3 sections down, a 1 or A, 2 or B correction, 3 or C to a new low. So let's take a look where we at as of the last bar on the chart. Is that, again, 5-wave, beautiful 5-wave decline down. As of the last day on the chart, potential for having completed an A, B, C correction. It certainly has reached the price probable price target zone for a wave C, not only a bit above the 62% retracement, but not too far above the high so far, is the 100% alternate price projection of the wave A from the wave B low. So, boy, this is putting the SPY in a really solid position for in a position to have completed or to complete an ABC correction, which should be then a wave 2 or B correction. So what's the simple things that we look at if a market's in a position to have completed an ABC correction? In this case, it's in a pattern and a price position really clearly. Now, the daily momentums are not yet overbought. But if the SPY should decline and trade below what I have labeled as a wave A high, that would indicate that's an overlap. It's not a closing overlap because this is only 3 days worth of data. So on the daily data, we don't have that nice A, B, and C. It just shows up on the intraday data. But a decline below the wave A high would at least be a warning that the SPY is in a position to have completed an ABC correction. Now, since we don't have that better defined closing overlap, what would be the definitive signal that an ABC correction is complete? Well, a trade below what I have labeled as a wave below. So we'd look at a decline below the potential wave A high as a wake-up call that the SPY is in a position to have completed an ABC for wave 2 or B. What I do is I set this as a price alert. Let me just do that right now. Make it a price alert. And there we go. Put OK. And I would look and see what where the market's at if that price alert gets hit, to see if there is a trade strategy that I could use to enter without having to wait for a market to decline below the potential wave below. And then, of course, definitely if it trades below the wave below, that's an immediate go short position. So before that even happens, what if there's no setup prior to the decline below this potential wave below? If it declines below that low, that's a really strong immediate signal that the trend is bearish, that it's completed an ABC correction. But boy, potentially the stop's going to be all the way back up here. That's a really big stop on any sort of leverage trade, certainly on a futures trade anyway. Too much for me to handle, at least. So use this information for either unleveraged, short position on the SPY, or a bear ETF fund, or a mildly leveraged bear ETFs. I use those 2 and 3 times leveraged bull and bear funds on ETFs all of the time when there's too much capital exposure for a futures trade. So the point is, if we're really solid on our analysis and understanding of the probable position of the market, we want to take advantage of it. So I'm going to add some data on here, and then we'll come back and take a look at where we're at. So there we go. As of the last bar in the 60-minute chart, the SPY indeed came down, as traded well into the range of what we had labeled as the wave A high. My price alert went off. But to go short on here, there's really no impulsive decline. There's not a good swing. This isn't a really solid signal that a ABC correction is complete. So frankly, I wouldn't go short here. I'd have to wait for a better signal. And right now, that only signal is a decline below that swing low. So I'm just going to have to hang loose and see what develops here as the days go on. So I'm going to add some more data on the 60-minute chart. So there we go. As of the last bar on the chart, which is the next day, it's in the morning, I think, of the next day, took out that swing low. From my point of view, there wasn't another opportunity for the end of this day and before this day for a signal to get short. So this is the go short strategy. And again, just use unleveraged data. So let me clean this up a little bit, and let's take a look at where we're at. So it's short below 462.50 with a stop all the way back up here, which is at, let me just put that up here, 472. Boy, that's why we wouldn't be doing a futures trade with 100 S&P points as a stop. But as an unleveraged trade on like a bear mutual fund, this is a great setup. So, and for what would be the target on the downside? Well, as you know, we'll talk about risk reward later on, potential rewards and targets and all that. So let's just keep it real simple. If this is a 1 or A, and if this is a wave 2 or B, then the next swing down should be about 100% of this. So I'm not going to do any math. I'm not going to put any numbers on here. But if I look at this swing down, that would be fairly substantial decline. Yes, there would be a fairly substantial capital exposure here, but hopefully we're going to continue to manage this, and we're going to be able to bring that stop closer to the market. And even if we're not, we just adjust our position size so we don't risk have any more capital exposure than what our trading plan calls for. So again, if it's a large stop, small position. So that's what we're going to do. And by the way, this is a trade I took. It's a trade we had in our DT alerts. So let's continue on and see how it works out. So I'm going to go back to the daily data and add some daily data on. Once we either have in a position to adjust the stop, or if we've taken out this swing low of January 10th, I think it is I'll come back and we'll take a look at where we're at. There we go. As of the last bar in the chart, the SPY has declined to a new low. So it's confirming that this wave 2 or B correction should be complete, or that should be a wave 2 or B high. Let's just label it as such. And let's just take off a couple of these. We don't need those anymore. Clean the chart up. I'm going to actually reduce the number of bars here. So the SPY has not only made a new intraday low below this swing low, it's also made a new closing low. So should we adjust or stop? Well, probably. Let's take a look at the 60-minute data, see if that's any help to us. Well, here's what I would be looking at. And here's the 60-minute data as of the end of that daily data where we declined, the S&P declined below the January low, is that we have as the end of this day a few days ago. Well, let's just be the prior day. This looks like it's probably a Friday and this is a Monday. As we made a really distinct swing high and then a gap open on the downside and then continued down throughout the day to a new low. I would adjust the stop to above this little swing high, because if the trend is bearish, if it's going to continue bearish, really shouldn't come up and take that swing high out, now should it? So still, if the market were to turn around and advance, we'd still have a small loss because it was short from here. And let me just make that thick and then make this red. That's where we went short. And then we're going to have our stop above here. So we really were able to adjust the stop quite close to the market just the following trading day. That's good. So now we're down to a very minimal capital exposure if we should get stopped out. So what's the next waypoint that we might want to be looking for to adjust the stop? Well, I would look at a couple of things. And again, this isn't a mechanical system. You got to use your head, and what you know is that if the SPY got in a position where there was a clearly defined 5-wave decline, then I'd look to adjust the stop in half the position. Or if the daily momentum's reached oversold, I'd want to be adjusting the stop on at least half the position. So again, we adjust the stop on half the position as if the market were making a corrective decline. It's already in a position that made a 1 or A or 2 or B. So if it's in a position to maybe make a wave C low, we'd adjust it. In the event that it's just making a correction, we'd keep the stop on the other unit quite far from the market until it's in a position to potentially have completed an impulsive decline. So let's just add some data. And again, it's how we think as each new piece of information is added onto the chart. Let's continue to add some daily data. Well, there we are 2 days later, a big solid decline, good grief. I don't even need to do the 100% alternate price projection. You can look at that. You can see it's reached at least the 100% alternate price projection. The daily momentums, and this is important, the daily momentums have reached oversold. So if the SPY were making an ABC correction, it's in a great price position, it's in a dual time frame daily momentum position, I'd want to be trailing the stop very close on 1/2 the position. Keep the other half of the position. At this point, we can put it at break even. So my typical trade strategy here is on half the position is to exit half of the position on a higher close. In other words, I want the market to indicate that it's making a low, it's making this daily momentum low, and a low that's going to be followed by either having completed an ABC correction or making a correction greater than any since this high. So that's the strategy, and that's the one I use a lot of times for my own trading and what we recommend in our DT reports. So we're going to move the stop. Let me go back to the 60-minute data. Okay, so this is 60-minute data as of the last day that I had on the daily chart, as of this bar. Boy, big down day where the daily momentum's got dual look back oversold. So we're trailing the stop on half the position, exiting on a higher close. The other half of the position, I'm just keeping it at break even for now. So that would be right where we entered, around 462.50. So I'm going to go back to the daily because I'm exiting on the daily, a daily reversal. Now, if you're following markets intraday, you might have a little bit different trade strategy. I always assume myself, and for our DT Alert subscribers anyway, that they're not necessarily trailing the market during the day, that they can't watch them, not trailing the market, but they're not necessarily watching the market tick by tick during the day, but they can take a look at the market near the close. So here we go. We'll add some data onto the chart. And I'm feeling pretty good here on unit number one anyway, is that we haven't had that higher close yet. And I'm just going to keep adding data till we get a higher close. There we go. Oh boy, look at this day. So we had this huge down day on that day, but came up and closed near the high of the day and had a higher close, exited on the close. Now, I realize a lot of you are going to look at this and say, oh my gosh, that's probably, how much? That's a 100-point range day. That's a huge range day. Of course, as you know, there is some, serious news going on around this time with the beginning of the Ukraine problem and potential, war, that sort of thing. So we just happened to get on the right side of the market during this decline and ended up, even though we certainly didn't sell the top or even sell the extreme of this wave 2 correction, but we had a really high probability trade on the short side following this little ABC wave 2 or B correction, and then took a substantial amount of this decline for a net profit on just half the position. Even as of now, the second half of the position is just at break even. So what's our strategy on the second half of the position? Well, we got a 1 or A, 2 or B. We've made a daily momentum bull reversal. More than likely, we can call this a wave 3 or B. So there we go. I've cleaned up the chart a little bit. And if we look at this as a 3 or a C, number one, what should the market not do if it's a 3 and it's going to make a wave 4 correction? Well, it shouldn't trade in the closing range of the wave 1, which is all the way back up here. And typically, it'll make a 38 to 50% retracement. So I'm going to just put all of the data on the chart that I'd normally be looking at. And we're going to assume that the SPY is making a wave 4 correction. And when the market is in a position to have completed a wave 4, then we're going to bring our stop no further than just above that wave 4 corrective high. So I don't know what's going to happen. What I know is we made a substantial gain on half of the position based on really logical decision making. What I know is that the SPY is in a position to have completed a wave 3 or a wave C. And so now I want to see how the market unfolds if it make a possible wave 4 correction. If this advance is corrective, then it's going to give me an opportunity eventually to adjust my stop much closer to the market, maybe capture a bit more on the downside. So I'm going to add some data, and then I'll come back when we're at a critical juncture. So I've advanced the data a few days. Let's take a look at where we're at. This is the daily data. And as of the last bar on the chart, just 3 days after this low was made and half the position was exited, where are we at as of this point in time? Well, it looks like this is making a correction. We'll take a look at the intraday data in a minute to see if it confirms that that's probably the case. But the daily momentums are dual look back oversold. They've actually been deep oversold for a long time. So it should be near making a daily low. Let's take a look at the weekly as of that period of time. And as of that day, that's that big reversal week. The weekly momentums are also dual look back oversold. We may be getting close to making a weekly low. So let's take a look again at the pattern position by going to the 60-minute data. Here's the 60-minute data, again, as of that last daily bar in the chart. Well, this really looks like a correction, doesn't it? Even though the weekly momentums are oversold, the daily momentums are oversold. indicating we're probably pretty close to making a significant low. The point is, this is very clearly a corrective pattern. So a couple of things here as far as the trade strategy. Number one, in the second unit, we can bring that stop down below the wave 1 or just above the wave 1 or A low. Because what should a wave 4 not do? It shouldn't trade above the 1 or A low, or the potential wave 1 low, excuse me. And we might even bring it a little closer to that, because typically a wave 4 correction would not exceed the 62% retracement. But I'm going to leave it here. Would still give a small profit. It'd be kind of disappointing given this significant decline. But now let's take a look at the position. Is the market in a position to logically bring the stop closer to the market? Well, if this is a correction, and as of the last, this is the last daily bar. These are the 60-minute data. During this day, it indeed traded below this swing low. Only by a tick or two, so not by much. But given that the daily and weekly momentums are oversold, that would be a good signal to bring that stop pretty close to the market and assume it's either made a correction or it hasn't made a correction, So this is definitely a corrective pattern. It has taken out the swing low, at least by a tick or two. So adjust the stop to above the swing high made during that day. So it came down and made a new low, swing high. It's either going to continue lower or it's not. So we have some cross currents of the technical information here, and the momentums daily, weekly are saying we're getting pretty close to a significant low. The pattern position is saying potentially we're completing a correction, going to go down to a new low. So this is exactly what my recommendation was when we got in this position. Let's get the stop pretty close to the market, because, listen to my language again, the SPY is in a position to have completed a corrective wave B and continue lower. So the pattern position is indicating that we want to get the stop close to the market because the momentums are all oversold. So let's add some data onto this market. We'll just add it on the 60-minute data, and we'll keep adding until it either makes a new low, which it just did, by another few ticks. It's indicating that this market is going to continue lower. And given what we experienced here, hold on to your hats if we've completed a corrective low. Not completed a corrective low, but completed a corrective high. Oh boy. At the end of that day, got stopped out of the short position. This still looks like a correction, doesn't it? Well, we got to make a decision based on the best information we have. Got stopped out of the short position of the second unit at 441. Let's just call it 442. And we'd gone short up here at around, 462, 465 or whatever. Again, keep in mind, this is the SPY, it's not the S&P, so 20 SPY points is like 200 S&P points. Nice percentage gain. So it ends up that the second unit got stopped out at about the same position as we exited the first unit, right around in this area. This was exited on the close of that day. This was exited intraday on a stop above this swing high. So hopefully you see how this was all logical decision making. Now, at the end of this day, this still looks like a correction and a potential for continuation to a new low. So this is what I call one of those aggravating exits, because at the end of this day, I exited the market, but it certainly looks like this is a correction and eventually it's going to turn around to a new low. So I'm going to go on the daily data where we're at as of this day, the 28th. That's the day that we're stopped out. Well, that's a very positive day, actually. That's an outside bull reversal day, and the daily momentums made a bull reversal as well. Even though this looks like a correction, we may be out just in time. And it looks like, actually, we were. Indeed, that the market had a significant advance. Now, as of the last bar on the chart, just made a dual look back daily momentum bull reversal. Is this a corrective high? Could be. What we just want to do is take a look at this decline and this trade strategy on where we entered on a logical setup. We adjusted our stop each time the market itself signaled that we should adjust the stop. We can identify a specific level that the market should not go to, and that's where we adjusted our stop to. And we didn't sell the top, we didn't buy the bottom, but we went short or sold near a corrective high. We exited near the extreme of the low and very logical decision making. And we exited the second unit. Turns out we exited it at just about the same level we exited the first unit, but it was under different circumstances and different conditions. So that's from entry to exit, multiple unit, logical decision making. Let's take a look at the S&P right up through the date that I'm recording this and see what we might want to plan for in the days ahead. Let's take a look at the S&P, and I'm going to look at the S&P cash index. That's usually the main one that I look at, and then I might take the trade on the futures or even one of the other stock indexes, but that's the first place I look is the S&P cash index. So this is the weekly data for the SPX, but it's the weekly closing data. I'm just looking at the closing data, smooth everything out to get an idea of where we're at. So there's just one piece of really important technical information we can get from the weekly chart. Let's take a look at this. Is as of the last data point on this chart, and by the way, I'm recording this on a Tuesday, basically after the close, so the last weekly bar isn't complete, but it's irrelevant from what we're looking at. And that as of the point in time when I'm recording this at least, is the weekly momentums are bullish, they're not overbought, and boy, they've just had a terrific advance off of the low of a couple of weeks ago. So that's where we're at. The daily momentums are bullish, they're not overbought. This is a potential wave one or a low. That's a big question mark at this point in time, but it's irrelevant from the immediate trade strategy we look at. Again, we're not forecasters, we're looking for a trading opportunity and something that's going to last several days to several weeks. So as this point in time, the momentum's bullish, ought to be sideways up for another 2 to 3 weeks before it makes a weekly high. Let's go to the daily data. And again, I'm using closing data. Let me hit the normal key here. This decline has 2 or 3 different potential wave counts. As I explained in the last couple of weeks to our subscribers, and then I went into more detail of the various wave counts, is all of them, there are really 3 potential ones on this decline, from impulsive to corrective, is that each one of them indicated that we're probably making a weekly low around this point in time and be sideways to up for 3 or 4 weeks. Of course, it's already been sideways to up in very impulsive fashion for about 3 weeks. Let's look at this data, and this is the only data that's really relevant right now. Off of the early March low, this is impulsive. There's no other way to look at that. It's impulsive. So if the S&P were making a correction, this can't be the end of a correction, because a correction should not be a clearly defined impulsive swing. If anything, if it is a higher time frame corrective rally, this should be a wave A. And given that the daily momentums have reached dual look back overbought, once again, as of the last bar on the chart, more than likely a daily high is very near, but that should be a wave A high. Now, even if it's beginning an impulsive higher time frame bull trend, is again, this should be a wave 1 or A high. We should have a wave 2 or B correction in the days ahead. So if the weekly trend is bullish, the weekly momentum trend is bullish, but we're near a temporary high, we call that a daily high, then a decline should be a correction within the weekly bull trend. If the person were a full-time trader, they're watching the market during the day, they might look for an opportunity to go short because more than likely the market would be sideways to down for several days, but that should be a corrective decline. The safest and best trade setup coming up, I believe, and what I would be preparing for in the days ahead would be a potential correction, and to identify the end of that correction. If the higher time frame weekly trend is bullish, we'd want to identify a corrective decline and participate on a continued bull trend, potential continued bull trend. So I don't know if the market's going to make a correct or make a daily high here. It's in the technical position to do so. The daily momentums are just making, we call this a momentum double top, pretty strong position to be in to make a daily high. And plus, it's just a beautiful 1, 2, 3, 4, 5 on the closing data. And it's coming close to the 78.6% retracement. So everything's coming together to probably within a day or two, complete a daily high followed by a corrective decline. So all of my focus in the days ahead is going to be focusing on identifying if the SPX gets in a position to complete a correction. And notice my language again. I don't know what's going to happen, but I can identify if the SPX gets in a position to complete a corrective decline, both by the pattern, by the momentum cycles, potentially the time cycles, etc. If it gets in that position, then it's going to be in a position, daily and weekly momentums, to complete a correction followed by continuation of this bull trend, and potentially to a new high, significant bull trend. Because already in this impulsive advance, it's nearing what would be the extreme of a correction if the higher time frame was bearish. So let's just ignore, and that's what I'm doing, is I'm ignoring this decline and whether it's part of an impulsive trend or if it's completed a correction. I'm focusing right here because this is so clearly defined. So that's my trade strategy for the S&P in the days ahead. You'll see how it worked out. You're going to be viewing this well after the fact so we can see if the S&P indeed made a clearly defined correction and gave us an opportunity on the long side. Let's begin by taking a look at a gold trade and how we look at it in terms of the position of the market, the probable trade setup, as well as what the initial capital exposure would be, depending on where we entered that trade and where the stop is, and then how we might manage that trade as a multiple unit, at least 2 unit of trades. So here's gold daily data. As of the last bar on the chart is November 3rd. Let's just take a look at where we're at here. Let's go from the bottom up on the technical position of the market. This, of course, is the daily momentum. Daily momentum is oversold. At this point in time, the weekly momentum was bullish and not overbought. So, again, we're looking for setups to enter the market on the long side for a continuation of the weekly momentum bull trend. So we have the weekly momentum's bullish, the daily momentum is oversold. We're at or near a position of a dual time frame weekly daily momentum setup to continue a weekly trend. Here's some time factors as of the last bar on the chart. Just a simple short-term low to low to low. It's as of the last day on this chart. There's a little longer-term low to low to low, which would be the following day on the 4th. And then if this is a corrective decline, I have the 38 to 62% time retracement of this advance. And that's the 3rd to the 9th. So the 3rd would be typically the minimum expectation before a corrective decline would be complete. So that's where we're at as of the last bar of the chart. We're right in that ideal time period to complete a corrective decline. And as of the last bar in the chart, it's around the 50 to 62% price retracement, typical for a correction prior to the continuation of the trend. So before we look at pattern-wise, why have I marked off this high? It's a secondary high. It's not the highest high of this period of time here. In fact, the day before, it spiked up higher than that, although it closed down this lower half of the day. And then this day, a few days ago, it also spiked up. It closed around the midday. Let's take a look at the intraday data to see why I'm doing the price relationships and the time relationships from the high on the 25th and not the day earlier or the day later. Well, here's the 60-minute data. So this is that day before, and we can see that it did cover 3 or 4 hours of this spike up and then just came down to below where it began the day off. So there's obviously, this is a news event of which there was a dramatic reaction to it short term over a few hours, but by the end of the day, the market was back down, actually below where the active trading day began. And how about this day over here, a couple days after this high? Well, in that day, this spike high occurred over just this 160-minute bar. So we could go down to 15-minute or whatever. We could even see this might have been just like a very, very short period of time where it went to a new high. And then again, it came down and closed near the low of the day. So it didn't change the trend of the market at all. So typically what I do is I just, particularly days like this, I just ignore them as extremes and take a look at the closing data because they're obvious news events. And I've talked about that throughout the courses. And let me go back to the daily data. So it really wouldn't make much difference if we use this high for the time or the price relationships. So I'm just going to go ahead and use this one. I'm just going to ignore this because you can see it closing wise. It just came down and closed near the lower half of the day. So they'd be about the same regardless of which one we used. The bottom line that we have coming off of this high, a decline, correction, decline to a new low, new closing low, a correction back up, closing into the range of the initial decline, and then another sharp decline down. So I labeled this as a probable A, B, C, D, or some sort of correction, I guess is the best way to put it. That's one possibility, is an A, B, C, D, E. But given these overlaps, a decline, an advance, decline, and then an advance and closing into the closing range of the initial and then a new low, that has all the characteristics of being a correction. So we have the weekly momentums are bullish and not overbought. Daily momentums are oversold. We're within the ideal 2-day time period to complete a low, and we're just going real basic, real simple low to lows and time retracements, and the real basic price retracements for what is typically a correction. Now, this is not a clearly impulsive advance. Do we care? Not if it's making a correction. We can figure this out later. But if this is clearly a correction, what follows a correction? Well, continuation of the trend to a new extreme. So it might be part of a much more complex correction or whatever. But again, I don't want to get paralysis of analysis. I want to identify if a market's in a high probability position, in this case to complete a correction, which is exactly what it's in. And once it's in that position, then we develop a specific trade strategy. In this case, go long. Now, this is futures data because I usually trade futures. So what would be a couple signals that this correction should be complete? Well, the first signal that it's probably complete, at least, given that it's reached the ideal time target to make a daily low and a corrective low, and it's in the price relationships for a corrective low, would be a close back into the closing range of this little short-term decline at a close above 1785.90. And a very significant, which is the higher one, there we go. And then a significant confirmation that it's complete would be a trade above this last swing high. That would break the bearish pattern, lower lows and lower highs. So let me set this up here. Just first, I like to get the colors correct. I usually make a closing line, a thick line, and a higher low, a thin line, just to distinguish them. It's just a habit that I have. So would we want to enter the market on a close above 1785.90? Or do we want to wait for a buy stop and a trade above 1799.50? From my point of view, this is where you can make a little decision. Certainly, buy stop to go long 1799.75 or 60, excuse me. Certainly a buy stop above this high. But from my point of view, I'd also enter a long position on a close above 1785.90 because of the strength of being in a position to have completed a correction, both so far making a low in the 3 and 4th, and we don't know if that low is going to hold, but if it should, and being in the 50-62% retracement. So that's the trade strategy. Go long on a close above 1785.90 and or a buy stop 1799.60. Where's our protective sell stop going to be? Well, it's going to be one tick below the low made prior to entry. So we don't know where that low is going to be yet. We don't even know where the entry price is going to be yet. But we can rough it out, and then when we get near that time to enter, we can determine the position size. So let's just look at a close at 1786. Let's just call it that, with a stop a tick below this low of 1761. Make it really simple, 1786, 1761. A 25-point protective sell stop if you're doing a futures trade. So a $25 stop on a futures trade, that's fairly significant. Probably more of a stop than what you'd want to take on a futures trade, at least from my point of view it is. I'd rather keep it under $10 or $12 maximum. However, I don't want to waste all this great analysis and this potential setup, so we can always take the trade in GLD, which is an ETF. So this is the GLD daily data. It's the same data we were showing on the gold contract data. If GLD has it's just 1 point, or excuse me, it's $1 per point, and basically the price is about 1/10 of what it is on the futures contract. So the stop on a close above, we'll just call it 167. The stop would be around 164. I'm going to round off here. So it'd be about $3 would be the stop. So we could determine how many shares would be our position size in GLD. And I usually, even if I'm trading in the GLD, I usually track the trade on the gold futures contract. So that's what we'll do as we'll go along. But so let's continue forward. We don't even know if this is going to be the low or anything's going to change. But what we do know is as of this point in time is we're in a position to complete a corrective low. So we're back in the GLD chart. Our trade strategy is simply go long in a 167.85 buy stop. That's a tick below this swing high, or on a close above 166.65. That's this closing low, this little swing low. One cancels the other. So if one comes first, we cancel the other one. So before, without even knowing what the exact entry price is, or what the exact protective stop would be, we can look at this and say, if the market continued to advance and triggered either one of the go long situations, the stop would be at least at 164.37, a tick below this low. If it happened before it hit the entry price, might have made a new low and then continued to advance, it'd be a little bit lower. But for right now, we can rough out exactly how many shares that we want to go along with, given our trading account. So let's take a look at the numbers here. Let's say we go long at 167.85, and our stop is at 164.37. 37. Now, it shouldn't be any greater than that. That's a $3.48 per share capital exposure, the difference between the entry and the stop. If we have a $25,000 account, 3% of that account is $750. That would mean the maximum capital exposure we can have for that trade would be $750. So we divide $750 divided by $3.48, and that gives us a maximum number of shares, a maximum position size of 215 shares. Pretty simple math. We can knock it off real quick. It's a bit of an estimate. We don't know the exact price we're going to enter at. We don't know the exact price of the stop, but it's going to be more or less those two figures. And if the following day we have either a new low is made, new daily low, which would be a new stop price, potentially we alter our go long strategy, then we can figure out the maximum number of shares. But more than likely, as long as the market doesn't go down considerably, and if this indeed is in a position of completed low, eventually when we go long about 200 shares. Don't get paralysis of analysis, around 200 shares or so. 215 shares. It's that simple. So let's add some more data and see where we're at. Oh boy. That's the next day's data. Certainly was in a position to complete a correction, wasn't it? Well, what happened on this day? Of course, we had this huge gap open, and then not long afterwards took out that swing high to go long at 167.85, and indeed the stop would be at 164.37. So because gold exceeded this swing high before the close, of course the stop close only order would be canceled. You wouldn't go long. So we should be long, we'll just say the 215 shares at 167.85. Let's add some more bars on the chart, and now we'll manage this trade as a 2-unit trade and see how we adjust the stops on each unit as the market progressed, if indeed it does progress. So I've cleaned up the chart a bit, and let's take a look at where we're at. I added a few days on. Gold continued higher. The next day was a big update to new highs, then 2 more up days. Let's go down and look at the technical change of the market as of the last bar in the chart. And the daily momentum has reached overbought as of that day, the relatively short look back. So we're nearing a position from where a daily high is often made if we have some kind of a reversal signal. So we want to be alert to that. Not too far above the market is the 100% alternate price projection of this section up from this low. That's another thing we want to be aware of. So is there a reason to adjust the stop? We always want to adjust the stop to where the market should not go if the trend is going to continue. And do we just adjust the stop on both units or just on one unit? Well, given that the daily momentum has reached overbought, we're probably getting fairly close to making at least a temporary high. However, we have continued to a fairly significant amount above the prior highs. So that would be a setup for me from my point of view. Let's at least adjust the stops on the 2 units to break even. But I'm going to add some more data on there and see if we get in a position to where 1 unit, we might want to bring the stop very close to the market. So let me add another. So here's the daily GLD, and I've advanced the data, cleaned the chart up, also advanced at the same spot we're at with the gold futures contract. So exiting on the close would be an exit at 174.18. Now, a couple of days earlier, the GLD had taken out this little swing low. As I said, I almost always do all of the technicals and the analysis and everything on the futures data. And then when the signal is made in the futures data, take the trade, exit the trade on the GLD. So that's a fairly substantial gain over the less than a 2-week period of time. So we've exited 1/2 the position. We still have the second half of the position. Is there any reason to adjust the stop? It might depend on partly on what's the higher time frame position. Is it in a position to make, in this case, let's say a weekly top? We know we're in a position to make a daily top. So should we anticipate, given the technical position, that gold is going to make a corrective decline followed by a continuation of a weekly bull trend? Well, that's when we go back to our weekly data, and let's see where we're at. This is the weekly data, and my cursor is on the last complete weekly bar before that trade was exited. And the weekly momentum is overbought. It actually reached overbought at the end of the prior week, which was the week of entry, but as of the time that we entered, it had not yet become overbought. So it's overbought. What does that mean? Well, that might make us cautious about holding on to that second unit, or at the very least, and this is how I'd phrase it, at the least, I'd bring the stop reasonably close to the market, given that the weekly momentum is overbought. And if with this particular momentum indicator, once it's been overbought for 2 or 3 weeks, usually means we're very, very close for making a price high. So we certainly want to bring the stop up closer than at break even, all the way back in here. What would be a good spot to bring it up to? So I've updated the chart once again, still the daily chart of the gold contract, and the daily momentums have been dual look back overbought. This is for 4 days. Very unusual for them to be dual look back overbought for more than about 4 days before a price high has been made. So I would adjust the stop to where the market should not go if the trend's going to continue to be bullish, and that is it should not come down and trade into the range of this last significant high for a trading overlap. So the ideal is that let me just adjust the data, is it doesn't close into this range, but because this top is, as of at least the last bar in the chart, it's already at a 50% retracement. I would not want to wait for a close all the way into the closing range, be closed below this area, but just for a trade below it. Again, that's what you call an executive decision, whether you do it on the close or the intraday, but I would do it on the intraday. So it would ensure at least a small profit came down significantly and took out that high, because this was the go long price, and this was where the stop would be, an intraday stop. Just a little bit below 50% retracement, as of that bar at least. So I'm going to take that off. We don't know if that's the high. That's the bar we exited half of the position. So let me add some more data onto the chart, and then let's see if we'd adjust our data. And here's my general philosophy, is that if this daily momentum makes another bull reversal, and the price is not traded below this low, whatever the low is after this bull reversal is made is where I adjust the stop to. So let's add some data and see if we get another setup to adjust the stop. Well, there's an outside bear reversal day, and the daily momentum's made a bear reversal. That would be what was anticipated. We'll add some more data on the chart, sideways. So far, it's holding up pretty well. We did have a bit of a decline here, but look at the daily momentums are getting near oversold, and the market's more or less just gone sideways. We may actually be in a good setup. Well, it wouldn't be for another long trade because the weekly momentum's already overbought. So again, if this daily momentum makes a bull reversal, we're going to bring our stop up to below whatever the price low was prior to that daily momentum bull reversal. Let's add another, no chance for that. Forget that. Just got stopped out. So we had a reasonable profit on the long side on half the unit, and then a much smaller profit on the second half of the unit. Let's go to the gold data itself and update as of that day. So I've updated the gold data as of that day. So again, stopped out at 169.53, about a little less than a $2 profit per share. So a modest profit on the second half. So all in all, a pretty good trade particularly considering the aftermath of this top and this big gap down and really significant down day that day. Actually managed to secure a partial profit. Inexperienced traders would go, oh my God, I just gave back so much potential profit. And as we know by now, there's no such thing as potential profit or paper gains or open profits. But the market moved so far against me when I was up at this level, then you have to ask yourself, was there something that changed in the technical position during this time period that would warrant you adjusting the stop closer to the market? Or did you make reasonably logical decisions on stop adjustment? So you do need to review your trade sometime if it moves against you that far before you get out again and say, did I miss something? And from my point of view, nothing was missed. This actually looked very much like a correction while it was going on after a clearly impulsive move up. And then we have 5 or 6 days sideways. That's almost definition of what a correction would probably be, and then continuation to a new extreme, but that's not what happened. So that was a good example of not only multiple unit trading and stop adjustment, but of identifying the initial capital exposure and where it might be way too great in a futures contract, but then you go to the gold ETF. Well, let's take a look at gold right up to date. We'll do a review for a preparation for the probable position of the market and a potential trade. And we'll look at it right up to date from the time I'm recording this. And that's what we're going to do with each of these lessons with a different market. So this is weekly gold. It's the June contract, and it's the close-only data. So I'm showing you the close-only data for a reason here. Well, for no other reason. I'm almost always look at close-only, whether it's weekly or daily charts. But this is the weekly close-only data. So I'm just going to isolate a couple of unique pieces of information that should help us develop a trade plan. And this is going back all the way, not quite a year, 8-9 months or so. This is an August 2020 high. It was a very significant high. Been sideways to down ever since then, actually. And we're recording this at early April, very early April. Well, let's take a look at a couple of key pieces of information here. First of all, coming off of this August high, is we had a decline. Then we had a correction, another decline, another correction where it closed in the closing range based on weekly closes of this initial decline. What's that? Well, that's a closing overlap, and it's usually a really good signal and setup that this decline is some sort of correction, one sort of correction or another, because an impulse trend doesn't have closing overlaps. So then there was another decline into what, at least for the past year, has been the lowest low. This was made in March of 2021, and I'm recording this in early April of 2022. So we have the closing overlap indicating this decline is a correction. If that's a correction, at some point in time, gold would continue to advance to above this August high. Now, it's been essentially sideways, a little bit of a net gain over the past year, but no real impulsive bull trend. But it hasn't voided yet that this is, again, a corrective decline. We can also look at the declines. I look at sections, and especially long-term data, on percentage change. First section down about 10.5%. Next section down almost 9%, so a little bit less. And then the next point down about 10.7%. So the point is, even on percentage change, this was shorter, so it couldn't have been a 1, 2, 3, 4, 5. So everything indicates that this is probably at least part of a correction, and that at some point, whenever the correction is complete, gold should continue a bull trend. Let's look at the data afterwards. We had an impulsive advance, choppy, corrective type of decline. Looks like a more or less impulsive advance, choppy, essentially sideways to down for several weeks, typical of a correction, typical of a correction. So far, these advances, they haven't been significant, but the advances have been impulsive. The declines have been corrective. Impulsive up, sideways to down. Very much impulsive advance to a new closing high, at least above this high. Impulsive up, more than likely what we would want to be looking for is that when a decline, or when a correction, when gold is in a position to have completed a correction off of this March 2022 high, that would be an opportunity to consider a long trade, because at any point in time that we can identify a weekly low and a corrective low, gold has the potential for continuing to a new high, if indeed it's worked out a correction here and it's in the initial stages of another bull trend. The pattern is telling us that any time gold would be in a position to complete a weekly low and corrective decline is an opportunity to position long for the potential of a continued bull trend to a new high. So we can look here at this is about a year and a half of weekly closing data, and we look at it in the same way as we look at daily data or even intraday data for that matter. So we look at it kind of the longer term and the shorter term. So let's also, before we go down to some daily data, let's look at how about our momentum cycles. Well, this is the stochastic, just a straight on, simple, slow stochastic that every charting software has available. So the stochastic doesn't always cycle between overbought and oversold, but you can look at the history of it and then you can kind of judge, well, where on corrective declines, where does it usually reach? And typical for a stochastic is around we use the 40 and 60%. So if the market's bullish, then typically on a stochastic, we'd look at the 40 level, that if the stochastic reached the 40 level, certainly the fast line anyway, it would be in a position from where corrective lows are made. Now, if the higher time frame trend is bearish, then we'd look at the 60 level on the upside. But if the higher time frame trend is bullish, then we look at the 75 level. So that's just kind of looking at levels from experience and history. But as of the last weekly close on this chart, it's only the fast line that's oversold, but it is warning us that we're probably within a week or two or three of completing a weekly low, weekly momentum low, which in this case would probably complete a corrective low. Now, it really could happen at any time now, since at least the fast line's oversold. So we're like on alert to identify if the market's in a position to complete a correction. If we look at the DT oscillator, that's what I usually look at, is only the fast line is oversold. And with the DT oscillator, we keep the 25 and 75 pretty fixed. So it would indicate that more than likely there's at least another week or two sideways to down. Basically the same thing that the regular stochastic is telling us. Once again, momentum indicators are momentum indicators. They all show us about the same thing. Okay, that's with the weekly data. And so the key piece of information we have is gold should be within a week or two or three at the most of completing a weekly low, which has the potential for being a corrective low followed by continuation of the bull trend. So we look at that. Our next question is, what can gold do to avoid the probability of a continued bull trend to a new high? What would void this as an impulsive advance? Well, whether we call this a 1 or a 2 or maybe 1, 2, 1, 2, that's kind of irrelevant. Let's just keep it really simple. A weekly close below that level voids a probable bullish outcome. That would be a closing overlap on the downside. So I just draw that in. We'll make it thick and make it red. And I leave that on my chart, knowing that at this level a weekly close below 1873.70 voids the probability of a continued bull trend to a new high and would indicate that we're in some sort of complex correction here and more than likely would continue to a new low. Who knows how this would fit in? I don't want to get it overcomplicated. I don't want to have to keep changing Elliott wave counts. I want to keep it really simple. I want to find the key relevant information. Okay, let's go to the daily data. So here's the daily data of gold right through that end of that last week. And what do we have on the daily data? Well, we certainly had this really sticks out as an impulsive advance here, doesn't it? An impulsive advance to a new high. And this is that on the daily data, the closing high from back in November that should not be exceeded on a closing basis if the higher time frame trend is bullish. So remember, the fast line of the weekly momentum is oversold. Typically, that means there's another week or two sideways to down before a weekly low is complete. Here's the daily momentum. And the daily momentum is bearish, although the next longer look back, this is the 1321 that I'm using because it's nice and smooth, tends to get overbought to oversold. The 21s already oversold. That indicates that, again, we're pretty close to completing a daily low, or we should be anyway. Our gold should be. So I'm looking at the pattern. Is that helpful? A impulsive decline off this top down to the 62% retracement from this advance. Looks like a little ABC. And then just in 3 days, it did make a new intraday low, but not a new closing low. And then it's been essentially sideways. So here's how I look at this. I don't see a trade right now, but there's two things I'm going to be looking for in the days and the weeks ahead. Number one is if gold continues sideways to down for another week or two and the weekly momentum becomes oversold, then I'm going to look for any reversal signal on the long side to position on the long side. Now that's as long as gold has not closed below 1875.90, the November 17th high. And we're going to look on a weekly closing basis. That's the more important one. So should that happen, that should be a great setup on the long side, again with that potential to continue to a new high. However, if first gold should make a close above this swing high close of 1967.70, then I'm going to reevaluate and look for an immediate, the conditions for immediate go long setup, because that would indicate that this whole correction is complete and it's, it wouldn't be an ideal kind of A, B, C, be something else had occurred, but it would indicate that more than likely this is complete. And I suspect if gold were to advance and close above 1967.70, the weekly momentum would reverse to bullish, even though it hadn't reached oversold. And here's something I forgot to look at just a little bit ago. Want to bring to your attention. Is this, again, we're back to gold weekly data. It's not the closing data. It's the intra-week ranges. But I've marked off over the last several months some highs and lows on this chart. And take a look at how regular these reversals are. Every 5 to 7 weeks, and typically it's on week 6, gold makes a reversal. So from the last low before, earlier on this chart, 6 weeks, 7 weeks the next low, 5 weeks the next low, 6 weeks the next low, 6 weeks the next low, 6 weeks the next top. And it goes back further than that. So we should be looking at this reversal cycle in 5 to 7 weeks from this top to make a reversal. That'd likely last at least 2 to 3 weeks. And some of these have lasted, 5 to 7 weeks. It'd be fairly significant that in about 2 weeks' time, the week ending April 15th is when this period begins. And it'll be the week ending April 22nd. That's week number 6. But we certainly want to be aware of where the market is beginning the week ending April 15th. So certainly, the technical perfect setup would be if gold happened to be sideways to down for the next 2 weeks, that would be into the week ending April 15th, and it would drive that weekly momentum oversold. That's not a forecast, it's not a prediction, but I'm just identifying scenarios that should that occur, I'd really want to be on the alert to complete some sort of corrective decline here, followed by continuation of the weekly bull trend. So we'll keep these in mind. These are some significant time factors coming up beginning in a couple of weeks. So I'll go back again to the daily data. So once again, I don't know where gold's going to go, but I've identified what would be the ideal technical setup to complete this correction. That would be sideways to down for another couple of weeks or so, and then making a weekly momentum bull reversal and then taking out a swing high. If it first closed above this swing high, then we'd have to take another look at the time position, the price position, and even the short-term daily momentum position for a potential of a high lasting a couple weeks, beginning that week ending the 15th. So that's it for gold. This is where we take a look at put all this information together, and there's not an immediate trade from my point of view in gold, but I think might be a really great one coming up if gold were to be sideways to down for the next couple weeks or so and not close below 1875.90. That would be the ideal technical setup to consider a long trade. So in this lesson, again, we've taken a look at a past trade and looked at it from the capital exposure perspective. We've looked at it from multiple unit trading perspective, how to make trade decisions logically. Then we've looked at this market, the gold market, up to the current position, how we look at the information, keep it relatively simple to begin with to get an idea of the position of the market and at least the general technical conditions to identify a trade setup in the days and weeks ahead. Let me set the stage for a bond setup. This data is the bonds weekly bond futures contract weekly continuous data up through around mid-November of 2021. This is the data going back to a little bit before the March 2020 high, that pandemic high. Subsequent to that period of time, it just looked like a beautiful five-wave decline, or it completed the wave 4 and was just in the initial stages of the fifth wave, which should eventually take bonds to a new low. So possible 1, 2, 3, and a 4. And I can tell you, everybody and anybody that followed Elliott Wave and follows Elliott Wave around that time was looking at this as a 1, 2, 3, and a 4. So as of the last bar of this chart, which is mid-November, there's a potential wave 1 of a 5 down. I'm looking for relatively short-term daily trends, let's say, daily and weekly trends, those that last a few days to a few weeks for trades. And as of the last bar in the chart, the weekly momentums were bullish. And the fast line was approaching the overbought zone, but it wasn't overbought yet. And typically, it reaches the overbought zone before a weekly high is complete, before a correction would be complete. So more than likely, if we just looked at this simple piece of data that's on the weekly charts, is there's another 2 to 3 weeks of sideways to up before it completes a corrective rally, if indeed it's completing a corrective rally. Let's take a look at the daily data through this period. So here's the daily data through November 16th. And the daily momentums are oversold, potentially in a near a probable setup to make a daily low while the weekly momentums are bullish. So that's the ideal dual time frame weekly daily momentum setup to consider a long trade for the continuation of that weekly trend. And what was compelling at this time was also the pattern position, and that coming off the October low, that was that higher time frame wave 1 I should have put in here. Let's just put it in for reference, wave 1 of 5, was a probable 1, 2, 3, 4, 5. So a 5-wave advance should not complete a correction. So we have the weekly momentums are bullish, which indicates that a weekly high is not yet complete, or it's not in a position to complete a weekly high, more than likely. The advance was 5 sections up, 5-section impulse, and yes, I realize what I've got labeled a wave 4 traded well into the range of the wave 1, but it never closed into the closing range of a wave 1, so more than likely this is a 5-wave advance, which would make it a probable wave A, and as of the last bar on the chart, possible A, B, C correction, right down to the 62% retracement. This is the 100% alternate price projection of the wave A from the potential wave B high. And these two critical price targets for a wave C of a ABC zigzag were also right where the wave 4 low is, which also is the typical retracement area against a 5-wave impulse trend. So put all of that together with the daily momentum oversold, bonds at this point in time were in the almost ideal position to complete an ABC correction. So I went through my spiel earlier on how risk rewards are all kind of bogus. That said, let's just consider this for a minute. If this is a correction, what follows a correction, and if it's a wave B correction, would be a continuation of the weekly bull trend to a new high above the November 9th high. So that's quite a ways up. And we could do the 100% alternate price projection of what's labeled the wave A, and that would be a typical target for a wave B, and that would be considerably above the November 9th high. So we don't even need to do that. We can just kind of look at this and say, well, there's quite a bit of room potentially on the upside if indeed bonds are making a corrective low. So if I'm able to enter with a relatively close stop, acceptable capital exposure, that's a really high reward to risk. In that if I can enter around this area, and we'll look at a specific trade strategy in a minute, with the probability of this completing a correction and continuing to a new high, well, there's a lot, multiple times on the upside compared to what the capital exposure would be on that trade. So this is really worthwhile looking for a go-long strategy with acceptable capital exposure. Well, let's take a brief look at the 240-minute data just to see if it gives us any additional information. So there's the 240-minute data up through the time of that last daily bar on the chart. 5-wave advance, potential A, B, C, and even this, if this is an A and that's a B, boy, that really subdivided nicely into 5 waves into that low as of that day of the 16th, didn't it? Really nice. And again, here's the price relationships. So the one thing that's not ideal is the time retracement to this 5-wave advance. We didn't really even have to do it to say this is probably less than a 38% time retracement of this 5-wave advance. But here it is, the 38% time retracement would have been a couple days later. So it's a couple days short of the ideal time retracement, even though it's the ideal price retracement. And this is just a simple low to low to low on the 17th, was just a few bars off of the last bar on this chart. So that's a nice time factor to complete what we consider a daily low. And of course, the daily momentums are oversold. But with the pattern is so ideal and the price level is so ideal, this is a great trade setup. So what would be a trade strategy as of the last day in this chart? Well, given that this has such a nice potential 5-wave decline, just a trade above the wave 4 of C high, and again against that potential wave 4 of C high, would be a go-long setup with a stop below whatever the low was prior to taking out this high. Because maybe the next day it makes a new low before it takes out the high, or maybe it's a couple days later or something. But that would be the trade strategy. So it would be fairly minimal capital exposure, fairly minimal stop for the potential of trading to well above this November 9th high. So we don't need to do a calculation of reward to risk. We just say relatively small capital exposure, relatively large potential gain. So our trade entry strategy would be a trade above, a buy stop above 160.23, or a higher daily close. So a higher daily close, a close above the prior day's close. Either one of those would be the entry strategy. So let me also put in, that was that wave 4 of 5 of C high, 160.23. So we have our trade strategy, our go long trade strategy, the entry and the initial stop, if the market fulfills that in the days ahead. So let's add some data and see what happens. Well, fantastic. As of the end of the next day, it was an outside, and this is what's called a two-close reversal day. So not only did it take out a little wave 4 or 5 swing high to initial long trade, but it did that also that day, close higher on the day. So we're long at 160.24 with a stop. Let's see what this low is over here. The low, one tick below the low prior to entry. I want to make sure we get the price in there. There we go. Stop at 159.19. So we know what our initial capital exposure is, and we would have known that more or less before the day began. We could just take this price and we could use this low, be close enough to figure out a capital exposure and the number of contracts that we would be allowed to trade. And of course, bonds, there's also an ETF we could use if we wanted to. TLT is an ETF. But this is acceptable capital exposure, at least for me in my account size, on a bond trade to get at least a couple, 2 or 3 contracts as of taking out this swing high. So let's see how we might manage this trade if the market continued to progress as anticipated. So we'll add data until we get to a point where we might want to consider adjusting our protective sell stop. Modestly up the next day. We always like to see that after we go long. And then, oh boy, the following day, a big up day, wide range, strong up day. Are we in a position to adjust the stop? Well, probably so. And what I always do, at least at the end of the day, take a look at the intraday data as well. This is the 240-minute data. And we can see this is at a fairly narrow range day after we entered on the long side, but it makes for a nice area, nice swing low that should not be exceeded if the bull trend is going to continue. So we can adjust the stop to this swing low, which is basically the low of the prior day. If we're stopped out, we still have a relatively small loss compared to if we were stopped out all the way down at the low back there. So we can adjust the stop in both positions to that swing low. The low, so 160.12 would be our protective sell stop, having gone long at 160.24. As the market progresses, if it should progress, then we'll identify if there's the market reaches another position to adjust the stop. I'm going to go back to the daily data. We'll add it day at a time. Oh, stopped out the next day for a small loss. What a dramatic reversal that was. So we went from what looked like, at least, a pretty ideal A, B, C correction for potential continuation of this bull trend to a new high to a dramatic reversal down. So we're stopped out for a small loss. I'm going to add a few more days onto this chart. Oh boy, it went down really strong the next couple of days. Let's say that we still anticipate that maybe this is an ABC and that bonds are making a correction. Will we want to attempt another long trade? Well, at this point in time, I would probably say no, because now the weekly momentum has reached overbought. So even though the pattern position is really strong to complete an ABC correction, I would avoid the trade, given that the weekly momentum has now reached overbought. And that's what this dark red line represents, as the higher time frame position of the weekly momentum. So I did add some data under the chart, and I cleaned it up quite a bit. Here was that snapback reversal day on the 24th, and indeed, bonds did continue immediately. Boy, what a big up day the next day was, to a new high, as anticipated, of this being an A and a B and a C. So even though this looked like a really good opportunity for a long trade for a potential ABC at this point in time, avoided that trade because the weekly momentums had gotten overbought. Well, let's stay with this bond data, because if indeed this is an ABC correction, what usually follows a correction? And that's a continuation of the trend to a new extreme, and that would be a new low beyond this October low. And let's keep in mind, in weekly data, this October low was just a wave 1, and that means this was probably a wave 2. Let me put the 2 up there. And if that's the case, not only would bonds probably continue to a new low if this is a completed ABC correction, but as we know, wave 3s are usually greater in time and price than a wave 1, so it could have a long way to go on the downside. So I'm going to go back to the weekly data, and let's take a look at where bonds are. And I advanced the data a couple of weeks. The reason for that is this is that high we were looking at. The weekly momentums were overbought but had not made a bear reversal. So overbought means it could be another 2 or 3 weeks before they complete a bear reversal, because frequently they stay in the overbought zone for a little bit, at least with this particular momentum indicator I'm using. But as of the last week in the chart, this is what's called an inside week. The weekly momentum made a bear reversal. So that's a setup. Again, if this is a wave 1, in this case of 5, and if this is an ABC, and this is all pretty much irrelevant as far as I'm concerned, if we have a market that's in a position to have completed an ABC correction, that's good enough to consider a trade strategy. And now that we have the weekly momentum bearish, we want to go look at the daily data as of the end of that week and see what the market could do to set up, in this case, for a short trade. And once again, even if you don't trade futures contracts, there are long and short ETFs for bonds and notes. That's why I look at bonds and notes all the time, because if they get set up, even if it's a large capital exposure, there's an ETF to take either side of the market. So let's take the daily data and get it through December 17th and see if there's a trade set up. And I'm going to move into the March contract, because, of course, the December contract is going to expire in December. So here we are as of December 17th. And again, that was that ABC correction. It's probably a wave 2. I should have put that on the chart so we keep our perspective of where we're at. Again, probably a wave 2 of the 5th wave, with, if that's the case, potential for fairly significant decline, maybe a very significant decline, once this correction is complete. Well, as of the last bar on the chart, bonds have probably made a wave A and a B, and the ideal price target for the wave C would be a bit above the market. This is the 100% alternate price projection of the wave A, and it's a 78.6% retracement of this initial decline, which I've labeled as a wave 1. And of course, a correction, wave 2 or B correction, typically the maximums around 78.6%. So right around there, and 100% alternate price projection, a wonderful zone to where should be the maximum to complete a wave C. And if we go down to the daily momentums, they're bearish. The daily momentum is bearish. So as of the last day in this chart, which is a Friday, the weekly momentum reversed to bear. On the daily data, bonds are at or near an ideal position to complete an ABC zigzag correction, and the daily momentum is bearish. So everything's in place to develop a go short trade strategy, or to enter on a bear fund. Bonds don't have to ideally reach that zone. We just know that if, for instance, the next day or in the next couple of days, whatever time period, bonds were to advance, this is likely to be the maximum upside before a bear trend continued. And it should be. This is also what's great, the very initial stages of continuing the weekly bear trend, because it just as of the last bar on the chart made a weekly momentum bear reversal. What's a trade strategy here? The trade strategy would be if bonds were to either make a lower daily close or take out this swing low, not swing low, but the prior day's low, a sell stop to go short, 161.29, a sell stop or a stop close only to go short on a close below 162.18. The same strategy used back here and used frequently is that either taking out a minor swing higher or low or making a higher or lower daily close is the trigger to enter a trade once a market's in a position to make a reversal. Let's add some data. Well, wow, the next day, really wide range day and closed lower, actually closed lower than the last two daily closes, really wide range day. But look where it poked up to, right to the end of wave C target, not just the ideal end of wave C target, but also typically the maximum for an ABC correction. So we can look at this and say, well, this now is just about a perfect position to have completed an ABC correction and then have come down and closed into the closing range of the wave A. So, boy, what a great setup and a great short trade, of course. We'd be short at 161.28 and with a buy stop, protective buy stop, at 163.20. A fairly wide buy stop. Depends on your account size, whether you would trade futures on this or whether you'd go to the ETF. I'm going to track it as if we're doing a futures trade, because that's usually what I trade on bonds and notes anyway. So fairly wide stop, so a very small position. So here we are, the daily momentum is still bearish in an ideal position to have completed an ABC correction. Do we need to get the calculator out to figure any kind of reward to risk? So the so-called risk or capital exposure is basically the range of the entry day with the probability of not just continuing lower below the December 8th low, but continuing lower below the October low, and maybe considerably lower if indeed this is the beginning of a wave three, actually a wave 3 of 3. These are the Elliott wave dream setups. So certainly a close below the wave B closing low, that's right here, and below the one, a trade below what I got labeled as a wave 1 low or a lower close would confirm the continuation of the bear trend, would confirm there should be an ABC wave 2 followed by a continued correction much lower, and also would certainly be the signal to adjust the stop. So let's add some data on and see how it progressed. So I've advanced the data a couple of days. As of December 23rd, not only had bonds closed below the closing low of what I got labeled a wave 1, but it had traded just by one tick below the low of the wave 1. The low on the 23rd was 160.11, and the low on what I got labeled as a wave 1 was 160.12. So bonds have closed at a new closing low and traded at a new low by just one tick. Is that an event to where we should adjust the stop to break even or closer to the market? Well, technically, no. Nothing's occurred yet to signal the continuation of the trend and where the bond should not go if the trend's going to be bearish. So let's take a look down here and why I say that. Is number one, the daily momentum has reached oversold, and that's a position from where a daily low is usually made. So this would just be probably at least the first daily low within this higher time frame weekly bear trend. So just as a general trade strategy, from my point of view, I usually look for a momentum cycle to make another cycle and a bear reversal before adjusting the stop. I want to give it time to give a clear signal of the continuation of the bear trend, clearly defined level to which should not be exceeded if the bear trend is going to continue. So let's add some more data, see when we get to the point where there's an event in a technical position to adjust the stop. So here's the 40-minute data as of that period of time, and we can see how the initial strong decline, and then some, we call it congestion, trading range, and this is through that holiday period, no surprise there, and then just a sharp continuation of the bear trend the next day. So we know that the daily momentums are still dual look back oversold. They haven't made that next cycle. But if this trend is bearish, certainly bonds should not come up and trade above this swing high. This is potentially some sort of a 1 and a probable 2 correction and continuation of the decline. Not only can we adjust the stop to break even, we can do a little bit better than that and adjust the stop to a tick over the high of this day, this swing high of 161.11. And the short was taken, I got to go back and remind myself, 161.28. So it ensures at least a modest profit, even if bonds were to come up and take out this high. And I think that's the high, the 161.11. Yeah. So let me clean the chart up here a little bit, and then we'll add some more data. So this was a logical stop adjustment. And I usually, if I put stops in, if they're buy stops, I usually color them green because that's positive if they're taken out. It's negative for a short trade, but it's positive potential reversal for the market. So I think that would be a logical place to adjust it. So let's continue to add some data and see when the next event is. And generally, going to wait until this has made another cycle in the daily momentum and bear reversal. And if this high has not been taken out, when it does that, then we'll take a look at the price position and the pattern position to, again, adjust that stop. Well, here we are just 3 days later, and bonds are just tanking. Had a little 2-day correction and then a really sharp decline. And still, the daily momentums are bullish and not overbought. But once again, what should bonds not do if this trend is bearish? Well, shouldn't take out this swing high. I mean, that's pretty obvious, especially after a day like this. So we can adjust the stop on both positions to above this high. So our stop on both positions now is at 160.19. So again, we're stopped out, made at least a modest profit, but we're in position here in the event that bonds continue much lower and lower beyond even this low back in November, the low in October. So potentially there's a long way to go on the downside. So I've added the bars on the chart, advanced it just several days. As of this last bar on the chart, January 5th, let's take a look at where the market's at, and if this is a significant position, we might want to adjust stops, is that as of this day, on the 5th, bonds have declined to 162% alternate price projection of this potential higher time frame wave 1 from the December 20th high. That would be at 157.04, and the 162% alternate price projection of this initial decline, or this wave 1, from this potential wave 2 high. These are a couple of key price areas that have the potential to end and make a low that's going to last at least several days. Now, the daily momentum, only the fast line's oversold, the slow line's just a fraction above, so it should be near a daily low. The weekly momentums are still bearish, and they're not oversold as of this point in time. So any low should be temporary. But this is some important price relationships. It's key area of pattern-wise to potentially complete at least a daily low. So I would begin to adjust the stop on one unit to I'd exit at a higher close or taking out the trailing 1-bar high. Either one of those when we get into this position on one unit. The other unit I'd adjust, but only down to the close of this swing low. And unit number 2 would be the stop at stop close only 159.13. Why that? Well, there shouldn't be a closing overlap if the trend is impulsively bearish as anticipated. And I still want to give it plenty of room to do another cycle in the daily momentums and to continue this decline because, frankly, it should just, again, be in the relatively early stages if, again, this is a wave 3 and actually be a wave 3 of 3. Let me put on here, I took off where that October low was, all the way back here. We're just coming down to test that low. This is on the March data. So there should be a much further to go on the downside. So I want to be very cautious about adjusting the stop in the second unit until probably we're well below this October low, if in fact that occurs, because there should be just a long way to go on the downside. Okay, so let's add some data and see where we're at. See, this is also the advantage of doing a trailing stop once you get into a key pattern or time or price target zone, is trail your stop instead of just exiting at that pattern. In the long run, the net gains will be substantially different. There we go. As of the last bar in the chart on the close, exited half that position or 1 unit of your short position or your bear position. Let me just clean this up. So I've advanced the data a ways. Let's take a look at where we're at as of this point in time. And I can tell you the weekly momentums are not yet oversold. Just the fast line reached oversold, I think, during this week. But let's take a look. Again, pattern is really important to look at. This is, again, a potential 1-2, and then a smaller time frame, 1-2 of 3. And then it looks like, and this is almost textbook, coming down from that December wave 2 of 3 high, 1, 2, 3, 4, 5, and that low is right in the zone of the 127, 162% external retracement of what I got labeled a wave 4. Of course, we really should have question marks on all of those. So it looks like, even though the weekly momentum is not at a low, it looks like the bonds, by the way, also they've just not too far below this October low. That was the wave 1 of higher degree. So again, there should be a long way to go on the downside. That said, given an almost ideal 1, 2, 3, 4, 5, if that's the case, there would probably be a wave 4 similar to this, and that's probably lasting a couple of weeks. And a reasonably significant advance. This advance was over 3 points. In other words, it would be a correction greater than at least this wave 4 correction. Is that something you'd want to sit through? Or would you want to look to take profit on the second unit, or I should say, advance the stop more aggressively on the second unit, and then if stopped out, take the chance that it does indeed have maybe a week to 3 week correction and give you another opportunity to enter on the short side. So this is one of those executive decisions that you can look at the technicals, particularly the pattern, and say, boy, there ought to be a long way to go on the downside. So what's your trading time frame? How much are you comfortable of a move against your position are you willing to take? Or would you like to trail that stop really close to the market? So I'm going to tell you what I would do. As at this point, there's enough information to say we're probably near a low that's going to last a week or two and have a reasonably significant correction. I'd trail the stop really close to the market. And I'd be at the point, because we're in this ideal end of wave 5 target zone, to exit on a higher close or a trail it above the prior day's high. So that's what I would look to do on this. And also keeping in mind that if stopped out, I would be looking for a correction and then following that a higher time frame correction and then a continuation of the bear trend, probably to much lower levels. And boy, the next day made this is called a bull reversal day, although the daily momentums are still bearish and not even oversold yet. But we exited that second unit for a very substantial profit, about 7 full points on the downside from the go short here to the exit on this close. Very substantial. Now, once again, I'd be looking if they made a higher time frame correction than these corrections that were just a few days. I'd be looking then to reshort the market, or do a new short, I should say, given that still haven't met anywhere near the objectives on the downside, probable, particularly on the weekly data. So let's take a look at the weekly data as of the last bar on the chart. So this is the weekly data as of the last full week before we exited that short position. And as you can see, only the fast line is oversold. And again, we've just taken out this low. And if this is a 1 and a 2, there should be a long way to go on the downside. So we might want to be really alert to another corrective advance to identify another short position. Let's take a look at the daily data, and I'll advance the data and see what happened. So I've advanced this daily data for at least a couple of weeks, and indeed, bonds were basically sideways to up for about 2 weeks. This looks like it could be making a nice ABC. Wave C, if it is anyway, wave C is not quite complete, or may not be complete at least. However, as of the last bar on the chart, the daily momentum made a bear reversal. This is definitely a corrective type wave structure. And it's been 10 days, essentially sideways, hasn't even reached the 38% retracement. So this last wave 2 correction was just 8 days. And then we had this 5-wave decline, probably a 3. Probably we'd call this a flat ABC, with the daily momentum just made a bear reversal as of the last bar of the chart. Is this a good trade setup to consider on the short side for a continuation of the bear trend? And this is probably making a correction similar to this correction as the wave 4. It's a 1, 2, 3, 4. And so it would tend to, if that's the case, then continue to a new low. So it's a pretty good trade setup for a new low. That the problem with this is the weekly momentum has reached oversold as of that bar on the chart. It looks like it's actually maybe the second week of being oversold. So a weekly low should be fairly near, and that sort of fits in with this being a probable 1, 2, 3, 4, and there's probably just one more spike to a new low based on the pattern at least before this higher time frame decline from the December high is complete. So more than likely, this would not be a trade I'd recommend to others. If you're comfortable, particularly if you can follow the market during the day and identify a closer in signal with very minimal capital exposure, like taking out a minor corrective low on the intraday, that would be a great trade to take. But for others, particularly if you're not following market during the day, it's probably not something you want to take. There probably is a ways to go on the downside. Let's just say this is the end of the correction, 127, 162% external retracement of the widest part, which is right there, of the potential wave 4, and that's assuming that it doesn't make a new high. But it is around 152.10 would be the minimum target on the downside. So a pretty good trade, but given that the weekly momentums are oversold, given that this is probably going to complete a higher time frame 5-wave decline, I would probably avoid it, but it's certainly a potential that a lot of traders should consider, particularly like with an ETF where you could take a very small position just to take advantage of a probable continuation of the bear trend. So I have advanced the data and cleaned the chart up a bit, and indeed bonds did continue lower. This was a correction, and a probable wave 4 correction as anticipated. And they actually exceeded the 162% external retracement of the wave 4, not by much, but by a bit, before completing that low and then making an advance, greater in time and price than any advances since the December 3rd low, indicating that indeed this is a wave 3 and is probably making a wave 4 correction. And when that wave 4 correction, that higher time frame wave 4 is complete, again, they should turn around, bonds should turn around and continue to well below the February low. So we had a great trade, didn't get the last significant swing down, and that hurts to have missed that, but exited on a pretty logical reasons, at least I think. Was this in a position to consider a long trade, by the way? Possibly. The weekly momentums as of this point in time had been oversold for a couple, 3 weeks, so they're in a position to complete a weekly low. So that put them in a position for a long trade. But let's take a look at bonds right up to date as of the day that I'm recording this. As we're doing at the end of each of these lessons, we're looking at the market as of the day it's being recorded to see if there's an upcoming trade strategy or we understand the position of the market, that sort of thing. Let's begin by looking at the current weekly data. So I'm back to the weekly chart of bonds, a continuous futures data, and I'm recording this on Wednesday, about noontime, April 6th. So this is the last weekly bar in this weekly chart, of course, is not complete because it's a Wednesday. But let's just take a quick review of the position of bonds. Is probable 1, 2, 3, 4, probable 1, 2, 3, 4, and 5. So we left off right around in here several weeks ago with that short trade that took most of this section out. But look at where we're at as of the last weekly bar of the chart. And notice how I phrase this. If this is a wave 4, the end of wave 5 target zone is typically at 127, 162% external retracement of the wave 4. And that's exactly where the bonds are right now. They're right in the middle of that zone. If this is a wave 4 of 5, the 127, 162% external retracements would be the ideal target zone for a wave 5 of 5. And that's exactly where we're at now, right just about in the middle of that zone as well, which is right in the lower end of the higher time frame end of wave 5 zone. So that's multiple time frame end of wave 5 of 5 target zone as of the last bar in the chart. So this bar is not complete. Potentially it's going to make at least a 13 look back bear reversal. The key information from this chart, at least based on just simple Elliott wave impulse pattern and end of wave 5 and wave 5 of 5 target zone, is bonds are potentially in a really high probability price zone to complete not only a weekly low, but it could be a multi-month low if indeed it's completing a 5-wave decline off of the March 2020 high. So we'd want to be on high alert here, depending again on your time frame, for a trade on the long side that could last several weeks to even several months. So we're in that ideal pattern and price level to do that. Let's take a quick look at the daily data. So this is the June contract of the daily data. Couple things to note here. I've got the 127, 162% external retracement of what this advance we considered on the weekly was the wave 4 of 5. Now on the June contract, it's already exceeded the 162% external retracement. Let me go back to the weekly. This is the continuous contract. On the continuous contract, it's right in the middle of that zone. And that's, again, the wave 4 of 5. So why is it so far off in the June, or so much different on the June than it is on the continuous? And that's, of course, because there's been a rollover of the contracts in March, near the end of March. So in June, hasn't been that rollover in the contract. So which one is more reliable? On something longer term, the continuous contract is the more valuable and the more useful price projections for the longer term, because it's closer to what quote unquote cash data might be. And we certainly can actually do this on the yield as well, and that's probably even better to do it on. But most people don't have the yield data, and most people have the futures data. So even though on the June contract it's exceeded the 162%, on the continuous it has not. So again, where are we at? We know that on the continuous contract, we're in a really key price zone. And let's take a look at the daily. The daily had this correction about a week ago. And if we consider that more than likely bonds are near the end of a wave 5 of 5, and this would be the wave 5 of 5, at any time we have a correction after an extended decline. This is that decline to a new low. It's a possibility that that's a wave 4, and I just do the 127, 162% external retracements, and this makes it like 3 different time periods from where potentially 3 time zones, maybe a wave 5 of 5 of 5 to complete a low. Would I go long on a reversal here? And generally no, not until I'd use that GAN strategy, is I'd look for a reversal and then an advance and then a corrective decline and another momentum cycle to hold against the low. And the reason for that is all the quote-unquote surprises have been on the downside, and potentially bonds are going to make a 13 weekly momentum bear reversal, and the 8 is already bearish, although the fast line is oversold, and this is a very significant bullish divergence between the momentum and the price. So everything's in place to complete a significant low, but I would wait till we get a really firm confirmation that low is complete before positioning on the long side. This is what we call trying to catch a falling knife, in that it's really set up nicely, but boy, look at some of these declines have been really sharp. And during this period of time, the Fed has announced that they're going to be raising rates. Well, it's kind of like, sell the news, buy the fact. So I wouldn't be surprised that at the next Fed meeting would be a significant time to when we would make that end of wave 5 of 5 low. So that's where we're at as of this point in time. But it could be a very significant low coming up here, at least within the next few weeks. In this lesson, let's look at how we can identify potential stocks to trade. So one of the big mistakes, since that's our theme for this lesson, that people can make if they're stock traders, is to not identify the relatively strong or the relatively weak stocks. You don't necessarily want to buy a stock that looks like it's bottoming out. You want to buy a stock or buy a stock just because the price is low. You want to buy a stock that's relatively strong compared with its sector and compared with the general market. And if it's been relatively strong fairly recently anyway, then more than likely it's going to continue relatively strong and outperform other stocks and other sectors. Focus on those that are relatively strong. Almost every software, charting software and trading platform, has some methodology to scan groups of stocks by various, could be momentum indicators, new highs, new lows, something along those lines, that'll identify stocks that are relatively strong compared to either the other stocks or the sectors or the S&P broad index, for instance. So what we're going to do here, I'm going to use the scan routine that I have in Dynamic Traders. And what that scan routine does is it identifies where is the weekly momentum for the stock indexes, and then for the sectors, and then for the individual stocks within the sectors. And it's the weekly momentum that indicates which is the trend direction you want to consider trading. And then it scans the daily data for momentum reversals in the direction of the weekly momentum. So you have, the purpose is identifying dual time frame weekly, daily momentum setups. Now, we don't want to trade those blindly, but we want to first identify which sectors and stocks are relatively strong compared to the general market. Then we bring them up in a chart and we'll apply our technical analysis that we've learned, the pattern position, the price position, time position, all of that, to then see which ones look like they're in the best, that they have the best opportunity for making that reversal or continuation of the trend. So let's do that. Let's do the scan first. Bring this down. I'm going to go back a ways so we can get an idea. And actually, the chart that I'm showing here is the weekly S&P data through around the middle of March, second week of March. What we knew is at that time that the weekly momentum had been oversold for a couple of weeks, I think almost 3 weeks. And as we know, at least with this momentum indicator, usually by the fourth bar of whatever time frame it is, in this case, the fourth week, the market will make a price reversal. The general outlook is that it looks like the S&P is reaching a position from where a weekly low is going to be made, and probably be made very soon, since the weekly momentums have been oversold for 3 weeks already, or 3 bars. So we want to scan for the relatively strong stocks, those that are as strong or even stronger than the general market itself. So I have a lot of portfolios of different sectors here, of ETF sectors, and then I have the 20 stocks, highest volume stocks for each of these sectors. So we're going to scan first the indexes with the focus on the S&P, and then we'll find the sectors that are relatively strong, as strong or stronger than the S&P itself, and then we'll find within those sectors the stocks that are relatively strong, and then we'll bring them up and we'll take a look at the charts and see which ones have the best trade opportunities. So let's do this scan. I'm going to do it back on the 11th. That's of the last bar in this chart. And I'm scanning for the weekly GT oscillator, the 8 look back, and the daily also the 8. Those are relatively short look backs. There we go. Took about 1 minute to scan. I think there's 22 sectors and 20 stocks or so in each sector, so 400 or 500 of the high volume stocks in the S&P. So we have results in all of the different portfolios. These results, ETF, that's just a portfolio of various indexes, not just the S&P, but it has the Dow, it has NASDAQ, it has the Russell, and a bunch of other indexes in it. And then I have a portfolio of the sectors themselves. And then, of course, each sector has a portfolio of the 20 high-performing stocks. Let's find one that looks like has a number of component stocks looking to make reversals, and let's see if we can bring those charts up and see which one might be relatively strongest. So here's, this is the IYR, the real estate sector. I'm always real interested in real estate trends because they really reflect the economy. So we've got the real estate sector. We have the S&P. Now, the S&P was actually, the rate of change here is a 4-week rate of change. Was actually negative almost 5% over the last 4 weeks. Well, we can see that as of this period of time. Why are all of these green? Well, that just means that the sector IYR, it was only negative 0.2%. So the IYR sector was relatively strong compared to the S&P itself. That's why it showed up on this scan. And then within IYR sector, here is 4 stocks out of the 20 that are relatively strong compared to the sector. In other words, the sector was just minus 0.2% over the last 4 weeks, and I give it a 1% leeway. So any sector or any stock that was minus 1.2% or stronger is going to show up. So we've got, here's AMT was just minus 0.9%, DLR is minus 0.4%, and then plus 0.5 plus 1%. So of the 20 stocks within the IYR sector, there's 4 of them that were relatively stronger and have bullish, it would be either oversold or bullish weekly momentums over here, as well as oversold or bullish daily momentums. So as we know, if the weekly momentum is bullish and the daily momentum is bullish, that's a dual time frame momentum set up to continue a weekly bull trend, at least. And we also identified that 3 of these stocks on the day of the scan actually made daily momentum bull reversals. So they may be right on the verge of continuing a bull trend. And if we have a bullish weekly momentum and we have a daily momentum that has made a bull reversal, what's that usually represent? Well, it frequently represents that this market has just completed we call it a daily low or a corrective decline against the weekly bull trend. Let's make charts of all of these markets, and then we're going to take a look at them at the chart. So I'm going to make a portfolio or workspace of charts. I'm not going to include the flat trades. Why would these be flat in here? Well, their weekly momentums are bullish. S&P is, they're oversold, or they're bullish. They're flat because the daily momentums are bearish. So the daily's in the opposite direction as the weekly. Once they make a bull reversal, then they'll show up as green. So I'm going to create a workspace that has all the symbols that are on long, or bull reversal, which is also long. In other words, they have the daily and weekly momentums in sync to continue a bull trend. So I can create the results workspace, or I could create a workspace that just shows those that made bull reversals this day. But I want to see these others that are have bullish daily momentums, and so I'm going to exclude the flat trades. And a flat trade, of course, is when the higher time frame weekly momentum is bullish, but the daily is bearish. So there's no dual time frame momentum trade set up anyway until the daily momentum makes that bull reversal. So I'm going to roll up this results menu and get it out of the way. We can always come back to it if we want to. And these are the S&P, the IYR, that's the real estate sector, and then those are the 4 stocks where the daily momentums were either made a bull reversal on the day of the scan or were already bullish, so dual time frame momentum bullish. Let's just do a quick look at each one of these charts and see if there's something that can tell us. We already know that each one of the stocks are relatively strong compared to the broad market S&P and the sector itself, the real estate sector itself. So they should all be good candidates for a long trade, given that the weekly momentums were either oversold or were bullish. I think they were all bullish. Now, these are daily data charts. This is the S&P. And we can see between February and the date of the scan of March 11th, essentially it was flat, sideways to down, but it had been down since early January. And I think we're going to see all of these had tops around late December, early January. So apparently the S&P and all these others are in a position to complete a weekly low. So pretty much flat for the past few weeks. Look at IYR. And just by looking at this, we can say, well, IYR has been relatively strong the past couple of weeks. It made a low around the same time that the S&P did, but it's been stronger over the last 2 to 3 weeks. Well, that's one of the reasons that it showed up in those results. It's in a relatively strong position and it should be in a good position to continue a bull trend. Looks like just a couple days ago it made a bull reversal. And by the way, when they make momentum bull reversals, at least with this momentum indicator, and if it's made kind of in the mid-range, that's a sign of strength. That's a sign of it didn't make full cycles and get oversold and all that to make a typical type correction. It essentially went sideways and then made a bull reversal. More than likely, when it does that, then it's going to break out to the upside. So here's AMT. It's one of the component stocks. Again, a little bit higher than it was in February, and so not quite as much as the IYR was itself, but a little bit relatively stronger, as we can see, than the S&P itself. It just made a bull reversal. I would think a breakout above this recent high, and more than likely it's going to continue. It's a good candidate. Here's the DUR, and it's been essentially flat. So it's on an equal footing as the S&P. But I'd be looking for something that's in the last couple of weeks has been relatively stronger. There's some buying that's come into the market. And so far, we're not doing anything fancy. We're just looking at charts. Here's this is the EQR. And just as of the day of the scan, it made a bull reversal without having reached the oversold zone. That's pretty positive. But look at this. Over the last couple of weeks since this February low, it looks like they've all made a low at the same time in February. There's definitely been relatively more buying coming into the market on this EQR. That would so far be on the top of my list to consider a long trade following a breakout, let's say a close above the recent closing high. We'll take a look at the specific technicals in a minute. Well, here's another one also. Obviously relatively strong, coming right off of that February 24th low. Much stronger than the IYR itself, which was, mildly up for that period of time, and certainly much stronger than AMT, which was essentially sideways since this time period. And again, we're going through them real quick. DUR, essentially sideways. So here's the two I'd focus on. The two relatively strong, EQR, PLD, as of March 11th. Boy, those would be a couple that I'd want to take a close look at for continuation of the bull trend. So how would we look at them from our perspective? Well, I'd look at this at looking for any corrective decline, and then once they have a corrective decline and they make a daily momentum bull reversal, well, new closing high, to me, that's the most solid kind of trend confirmation signal that we could have. We could do some simple retracements, that sort of thing. Let's just see in this last advance, came straight down to the 62% retracement. I'm just going to look and see. This is what I'd like to do sometimes when I bring a chart up. I look to see, does this market tend to make retracements at or very near one of the key retracement levels? And boy, here we go. Tagged the 78.6% retracement up to a new high. Came down and tagged the 62% retracement. Hasn't made a new high yet. With the daily momentum making a bull reversal, more than likely, it's very soon going to continue to a new high. But I'd like to have that confirmed. So here's what I'd be looking at. Again, keeping it real simple. This particular stock EQR was so much stronger than the IYR. And of course, IYR is relatively stronger than the S&P. But this is a great candidate for a continuation of the bull trend if it were to close above this high, make a trend continuation signal. Let's look at PLD. Look at some simple stuff here. Well, PLD has been so strong that it isn't even making corrections. It's just consistently continuing to advance. So this is another one, a great setup on a new closing high, since it has already made the bull reversal. So here's the two. It's just these two, as of at least this day, it's those two that I would focus on. Let me just bring this down again. We can see that the weekly momentums, of course, are bullish. The daily momentums are bullish. And it was these last two, EQR and PLD, that were relatively strongest. So I would be doing this scan each day because I'm going to just look at this. What you might want to be prepared for is, while these last four, they have their weekly momentums are bullish, but their dailies are bearish. Look at the relative strength on the rate of change, the 4-week rate of change, how much stronger they are than even these others, which have just made their daily momentum bull reversals. So on any day that they make a bull reversal, these will be fantastic candidates on the long side, just based on the dual time frame weekly daily momentum scan. Let's take a quick look at the weekly charts for each of these two a relatively strong stock. So this is a weekly chart of EQR. And as of that week ending March 11th, when the scan was done, if I look at this decline coming off of the January high, almost an ideal ABC. And then having already advanced and closed into the closing range of the wave A closing low. But look at this ABC, came right down to 78.6% retracement of the last fairly significant low a few months ago, and then reversed sharply. And then the last 2 weeks has been up strongly compared with the S&P, which was just sideways for those 2 weeks. So again, another sign of relative strength. The weekly momentums are indeed bullish, actually happen to be dual look-back bullish, and they're not overbought. So just typically on the momentum cycles, if they continue, we can see most times at least, it cycles between overbought and oversold. At the least, the fast line reaches the oversold on these corrective declines. But when it makes a dual look-back bull reversal, pretty reliable that the bull trend is going to continue. So once again, one of the mistakes, by the way, can be made is that you don't look at the higher time frame. You always want to look at the higher time frame. Could be weekly if you're looking to trade daily and weekly trends. Maybe you're a shorter term trader. The higher time frame may be daily data. And you need to look and see what the position of the market is on the daily data and then work down to the intraday data. So a big mistake is not doing multiple time frame analysis. So we have this is just a great bullish setup, and I know there's a lot of newbie traders, so to speak, that think, no, you got to buy the bottom. I need to have bought that ABC correction and right near that wave C low. No, there's no price too high to buy as long as the trend is up and not peaking or reaching an upside objective. So you just have to identify in the smaller time frame the entry strategy. And we've identified that with EQR. So it's just made a daily momentum bull reversal. And a close above this 88.61 would be a go long setup. Where would the protective stop be? Another big mistake is risking or having too much capital exposure. Well, the stop would only have to be below this swing low. I mean, this has either made a daily momentum bull reversal, which is going to continue the weekly bull trend, or it hasn't. And if it comes down after making the close above this high, following the daily momentum bull reversal, and then we're to take out this swing low, what would that mean? Well, the higher time frame trend is probably not bullish as indicated by the weekly momentums and this almost ideal ABC correction. How about with PLD? Let's take a look at the weekly here. Again, made a nice ABC to around the 68% retracement from the last significant low. This happens to be, it tagged a couple weeks ago or prior to this period of time, the 100% alternate price projection of the wave A from the wave B high. So again, it's a couple weeks away from this low, but the weekly momentums are bullish. They're not overbought. So again, we don't want to make the mistake of thinking that we have to buy the low in order to have a high probability trade. No, we have to identify that the trend is bullish, that it's not in an overbought position, it's not at an upside target price or time position. In other words, that more than likely trend is going to continue net bullish, and then we look at the smaller time frame to execute the trade. Now, this outside bear reversal day, that might scare people off. But boy, when you have a market that is just consistently day after day after day net bullish, and we can even see this look like a really nasty bear reversal day with a close below the close of the last few days, well, then it just turned right around, buying came into the market. The daily momentum is indicating that this is temporary and that we want to get long on the first trend continuation day, which would be a close above this high close. Well, let's add some data on to some of these. We're not going to follow them through all the way. Well, certainly proved to be relatively strong, didn't it? It all proved out that these markets were, or at least this one, PLD, was relatively strong, and that following this bull reversal was a good setup to consider a long trade. And here it made another bull reversal on just a 3-day correction and continued to advance. It looks like it's continued to a new high. Well, almost, as of the last bars in this chart. So let's take a look at EQR. Let's add some data onto EQR. Setup, close above 88.61. Traded above it, hasn't closed above it. Got to have that close above it. And it looks like it had made that bull reversal back here, then it just flipped back to bearish and then back to bullish almost right away. There's the bull trend confirmation and the signal to go long. Stop below this swing low. You could probably actually do it above this outside day low, because that's such we call that a trend continuation day. And if the trend is going to continue bullish, it shouldn't take out that low. So that's a pretty close stop for the potential of a continuation of a weekly bull trend. There we go. Another bull reversal. That's as of the day I'm recording this. So another bull reversal. So indeed, it was just a short time up. It didn't continue in the same manner that the PLD did, but it was certainly a trade, and it's still an ongoing potential trade as long as the weekly momentums have not reached overbought. So this is just an example of, first, stock picking. You want to have some method to identify the higher time frame trend, and then you execute following lower time frame reversals and trend continuation signals. And then you adjust stops depending on where the higher time frame momentum is. As the higher time frame momentum, if it reaches a point from where momentum highs are made on weekly data, that means a top that would last a few weeks, we would then adjust our stop on the daily a little closer to the market if the daily trend continued to new highs. So the big mistake here, let's go through some mistakes we could make. One is not identifying the higher time frame trend. Number two is not identifying a trade strategy that has acceptable capital exposure. And we would use the amount of capital exposure to identify our position size. And then another mistake that we could be making is that as a market progresses, is not adjusting our stop according to the probable trend position of the higher time frame. In other words, if the higher time frame, in this case the weekly, momentums and pattern position, that sort of thing, would be approaching a probable higher time frame reversal, then we would begin to trail our stop very close to the market. So if we, for instance, we look at PLD right here, we know that the weekly momentum has reached overbought, potential 1, 2, 3, 4, 5. Let's just see what the external retracements would be. Well, as of the last bars on the chart, it's reached a typical end of wave 5 price target with the weekly momentums overbought. We can see the daily momentums reaching overbought. That's a clear technical position to begin to trail the stop very close to the market. So in this lessons, we've looked at stock picking. We've emphasized a few mistakes that can be made. Probably the most important mistake is not to understand the position of the market, the relative position of the market relative to its sectors and to the general market when we're stock picking it. So I'm going to do one more scan, and I'm going to do it right up to date as of the end of the day yesterday anyway. Today is not finished. Once again, as I've been doing with all these lessons, let's look at the current position of the market and see if there's relatively strong sectors and stocks that we might want to focus on. So let me choose those. Let me get, today's the 7th, but today's not done. We don't have data for today. And again, I use the relatively short look backs weekly and daily, and we'll do the scan as of the end of the day yesterday. Boy, you can see as it goes through this scan is that the majority of the symbols are flat. But we'll address that in a moment. Let's go to the sectors. So here are the sectors, and again, this is a scan as of a Wednesday, not the end of the week. All of these weekly momentums are bullish, of course, because the S&P index is bullish, the weekly momentum, and the S&P is up 5% from 4 weeks ago. And all of these sectors were 4% or greater over the last 4 weeks. However, only one of their daily momentums is already bullish, and that would be the XLK. The other relatively strong sectors that we look at out of, I think it's 12 or 14 different sectors, there is only, as of right now anyway, 5 of them that have the weekly momentums bullish and have the 4-week rate of change within 1% or greater than what the S&P is. So we can look, here's the daily momentums on a couple of these. They're bear oversold. Those are the ones that more than likely within a day or two are going to make the bullish reversal in the daily momentums, and then they'll switch to long. So what I'm going to do, I'm just going to bring up this one XLK. As of today, this would certainly be one we'd want to take a look at. And this would be the sector, and then XLK is the tech sector. Tech's relatively strong. And however, all of their component stocks like Apple, Google, Microsoft, etc., of course, their weekly momentums are bullish, but their daily momentums are either oversold, and the reason it's green in here when they're oversold, it's like an alert. Although it hasn't made a reversal yet for the trades, dual time frame trade setup, we want to be alert to it because they're about within a day or two will make bull reversals. And the other daily momentums are bearish. So again, they're all flat other than the sector itself. So let's go ahead and I'm going to go back to the sectors. So if I make a workspace, I'm going to have one symbol in that workspace. But let's take a look at it and see where it's at. So I'm going to export the results into a workspace so I can take a look at the charts. Of course, the results here, at least of all the sectors here, is just going to be one chart. It's going to be of the relatively strong XLK, which has both the weekly and the daily momentums are bull for trend direction long. And before I do that, and hopefully in your software, you can export all results into like an Excel spreadsheet. So you have a list of every portfolio and every group and the results from all of the scans, just as a reference. So if you close up this routine, you might want to take a look at that Excel spreadsheet, and maybe you have another way to crunch the numbers or crunch the result symbols in Excel. I'll show you what that looks like in a little bit. So let's go ahead and let's do a Create Results Workspace. And so we're going to click on that, and we want to continue ahead. Yes, we do. And of course, once again, it's only going to be the one chart of XLK, the daily chart. So let's take a look and see what we got here. I'm just going to reduce the data a bit. And boy, it looks like a potential ABC correction. The daily momentums have been oversold for a number of days, almost since this top. So how I usually describe this is a daily low is overdue. So let's look at a little bit of price position with this potential ABC correction. So we're going to do our simple retracements. We'll do our simple 100% alternate price projection. And I'm going to do some simple time retracements. If it's a corrective decline, then it would typically be in the 38 to 62% time retracement of this impulsive advance. So here's what we got so far. We know that this particular sector ETF is relatively strong compared with the S&P. We know that at least as of the week prior to this scan, the week ending the prior week, the weekly momentum was bullish, and we know that the daily momentums are oversold. And actually, as of the day of the scan, which was this day, they were bullish. Because this is the day of the scan. This is the day I'm recording this, and the day is not finished yet. So that's the day of the scan. So boy, we're in a dual time frame momentum position to consider a long trade. We have a potential ABC correction, and this looks almost exactly like the S&P, by the way. We're right in the time zone of, this is the 62% time retracement as of today, and a 50% price retracement, a little bit below the market where the low was made on yesterday. So a great potential setup to complete an ABC correction. And as we know, what signals that an ABC correction should be complete, and that would be a close above the wave A closing low. So we could either wait for a close above this 156.46, or if we get maybe a strong, just a daily reversal signal today or tomorrow from this time and price zone, which is typical for an ABC correction, we might go long in a higher close. By doing the dual time frame momentum scans, by knowing that this market has been relatively strong compared to the general market, even though it looks very similar to the S&P, but it's had a better rate of change, equal to or better rate of change than the S&P, it would be a market we'd want to focus on. So I'm going to bring over the Excel spreadsheet that I exported. I actually exported this when we did that March 11th scan. And it just has all in one page all of the scan results of the relatively strong markets. As you remember, the S&P was either oversold or bullish, and so we were looking at the time for the relatively strong markets, and this just gives you the results for every one of the portfolios of the sectors. These are the relatively strong stocks. So these would be the ones that you'd want to focus on at this point in time when the scan was done.